Welcome to the Millennial Money Canada podcast, a podcast to elevate your financial planning literacy so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. I'm Guillaume, financial planner, and today I am solo on this episode. The topic of today is Millen Wealth's investment philosophy. I will walk you through how we advise clients how to invest their money based on their goals, because this is one of the reasons why Sam and I started working together and why we're building Millen Wealth the way that we're building it, because we share the same financial planning approaches and philosophies. But within financial planning, there's investment planning, and we also share the same principles that are governing our investment approaches and what we recommend clients on how to invest their money. If you've enjoyed this podcast, I highly encourage you to share this podcast, rate this podcast on Spotify or Apple Podcast, or if you're on YouTube, leave a comment, engage with us. We're always happy to see engagement and we're excited to respond to you. As disclaimer for today's podcast episode, it's only for educational purposes only. There's nothing that I'm sharing here today that should be taken as investment advice, because I don't know you. I don't know your goals. I don't know your risk tolerance. I don't know your financial situation. It's important for you to know that I'm only licensed in BC and Ontario to provide you access to mutual funds and exchange traded funds through Portfolio Strategies Corporation. So it's important that you consult a professional before investing. And if you want to learn more, you can book a meeting. We are running free 60-minute financial reviews, most likely until the end of February, but it is limited time only. And in this financial review, we can review your investment portfolios, but we can definitely review any other goals that you may have, questions that you may have, whether it's around cash flow, taxes, retirement, investment, estate planning, insurance planning. We can address them there. It's a no commitment meeting. And at the end, you can also learn how we work with clients long-term and make a decision as if it would be a good fit and go from there. So the agenda for today's episode, before we share with you our Millen Wealth's investment philosophy and the concepts and the building blocks of that philosophy, I'm also going to share my personal journeys, professional, personal, and how that led me to today, to being on this podcast, working with Sam, and sharing with you how we recommend clients to invest their money. Because if you understand kind of the background that I came from and the experiences that I've had, personal and professional, that will probably give you an idea as to how that shaped my investment philosophy today. So, and within that journey, you might also recognize yourself as to where you are in that journey. Are you at the beginning of your investment journey? Are you experienced? Are you still lost as to how you should invest money? Are you still making a lot of mistakes based on biases and being short-sighted and maybe lack of knowledge as well of what to do, how to do? Are you still reacting to market news and movements in the market intraday that maybe be taking you away from your goals? Are you still investing in funds that are have high management expense ratios, because you may not know that there are alternatives that are cheaper and where we can expect higher or better returns over the long term? Like all this, I don't know where you are in that journey, but I'm hopeful that by sharing kind of what I went through, you can learn and speed up your learning process and have a better understanding. So if you're listening to us for the first time, you can have access to how we think. And then when we get on the call, you already know what we're in a way about to share, like how we think or how we approach the financial planning game as well as the investment game. We'll cover the key theories that change the world of finance, because those key theories are the building blocks of index funds and then factor investing funds, which are a step further than index funds. And then the upside and the downside and the trade-offs between using index funds versus factor investing funds. And then also lastly, we'll cover the adoption, Canada versus United States versus Europe or global, which is very interesting. So stay tuned until the end about how behind Canada is at adopting this investment philosophy, which is not really surprising. So let's dive into it. So I want to take you back. By the way, I'm huge into stories. I love sharing stories. I love listening to people's stories. I love listening to people's goals and values. So I'm going to take you pre-university. When I was 18 years old, so around the 2008 financial crisis, I became obsessed with the financial crisis itself. I shared that in our first episode a little bit when we had Christmas and all the family was there. And then my cousin back in the day, he's, a CPA, CFA. He was in the field and he shared how Lehman Brothers went bankrupt. And I had no idea what he was talking about. That was major news in the financial ecosystem and had like major implications. That the government essentially didn't bail them out. They let that bank fail. And I just became obsessed with the financial crisis. Like the reason why the financial crisis occurred, I didn't understand anything about the world of finance. I didn't understand anything about investing. Both of my parents, love my parents. They are great. They taught me amazing values, and educated me extremely well. But as far as finances and wealth, like they are great at earning money and working really hard and savings. But as far as financial planning and growing wealth and optimizing their wealth, clueless. So I grew up clueless about how to make money work for you. And that's why I became a financial planner. But that's a sidetrack. So at the time, didn't have any understanding of the ecosystem. One of the documentary, if you haven't watched it, is called the Inside Job documentary. There are so many on YouTube, but I watched almost all of them. And I just became obsessed with that. And I knew at that point in time that I wanted to work in finance. And that's a broad term, but I wanted to, and then I went through different career ambitions. That's what I wanted to be in investment banking. And then I wanted to work for a hedge fund. And anyhow, then here we are as a financial planner. But it was a long journey. We'll get to there in a minute. So I went to the University of Victoria, where I got my Bachelor of Commerce in Finance. And it's at that point in time that I did an exchange in my third year to go to Singapore. And Singapore is one of the major financial centers in Asia. And listen to this. If you're, if you've been to university or takes any courses, most of them sometimes are not that exciting. But this was my semester in Singapore, okay? I had 5 courses. One was investment banking. Second was mergers and acquisitions. Third was hedge funds. Fourth was capital markets in China. And fifth was business law, ethics, and sustainability. It was the best semester of my life. I learned more in 4 months in Singapore than my 4.5-year degree in total. It was a transformational experience who I was exposed to. I mean, I was with the students who were doing internships at, Goldman Sachs, JP Morgan, and Morgan Stanley, all those big banks. It was like, kids were coming up from internship from big pension funds and sovereign wealth funds in Asia. It was like incredible. But at that time, this was my first exposure to the world of trading and investing. So I met some friends who were from Norway, and they showed me that they were speculating on equity indices, fixed income, US Treasury bonds, commodities, and currencies using a platform called Saxo Bank. And remember that because that's going to actually come full circle in a second. But they were the first ones to show me what they were doing. And I had little to no knowledge about like that world. So anyway, I opened an account at Questrade and I had $1,000 as a student. I converted to USD, and here's what I did with it. I bought 50%, so whatever that conversion was at the time, it was $700 something. I bought 50% Amazon stock and 50% Russell 1000. So at the time, I knew what ETFs were, or exchange traded funds or indexes were. So when I was about to buy Amazon, first of all, the reason why I actually bought Amazon, this is actually a funny story. I did a research through a course, at UVic, that I had to do research on a stock. And at the time, it was when they released the news about making drone deliveries, using drone to deliver their packages. And when I read that, I was like, oh my God, that's going to revolutionize the delivery system. And, that company is going to take over and whatnot. So that was my analysis. Keep in mind, that was before I understood that, current prices are reflecting all information and whatnot, and the market had already digested it. So I took 50%. I bought one stock of Amazon, but I was like, there's no way that I know how to pick, the best stocks. Or I didn't know at the time if, that was the right approach. I was like, I'll hedge myself and I'll buy index funds. I'll buy 1,000 stocks of the US market. So that's how I went. And then I think it was 3 months later, Then just Amazon stock went down and I sold it because I couldn't withstand the volatility there. But that was my first, those were my first two purchases I've ever made in the investment game. Now, fast forward to my graduation. My first job out of school is I started at Questrade in Toronto. And I started in the Department of Foreign Exchange and Contracts for Difference. Those contracts for difference are the products that when I was in Singapore, the Norwegians were using from Saxo Bank. And Questrade ended up white labeling their products through Saxo Bank when I was there. So it was a full circle essentially. But those products are using leverage. So they are very speculative. People would deposit, a few $1,000s, and then you can sometimes leverage up to 20 to 1. And then you would speculate on the directions of, let's say, where the equity markets will go, fixed income market will go, where the commodities, gold, oil, natural gas, or currencies, whether it's the USD CAD, right? Is it continue to go down towards 144, 145, or you take short positions, you think it's going to come back towards, 130 or 120. So you're speculating on the directions of different asset classes. So at Questrade, I was an investment representative. So all I was doing was mainly facilitating trades on behalf of retail investors. Those were unsolicited. So they put their buying and selling positions and I was just executing them if I was doing on their behalf, or usually they just use the platform. So I was doing more like sales, opening accounts, client relationships, trying to grow the business there and then get new investors to open accounts with Questrade. All this to say that this was a transformative environment for me. People were blowing up in matters of weeks because no one had a real understanding of how to manage risk, especially with leverage. So, when you're using leverage, you're putting a little bit of money down and you're controlling, let's say you put $2,000 down, but you're controlling $20,000 worth of position. So if it goes down 10%, you basically wiped out your equity. And then after that, you get into a margin call. So I learned a lot about risk management to cut your losses really fast in order to avoid margin calls, but also not use leverage at all. Or if you use it, you need to know how to manage the risk. And that was one of the best takeaway from that experience, especially seeing other people, just blowing up their accounts. And very few people were actually successful because like I said, we did spend quite a bit of time, or I spent quite a bit of time trying to educate people, especially if they were new to that space. Try to educate them, give them pointers. I couldn't recommend them how to trade, but giving them pointers to help them at least manage their risk so that they don't blow up. So I spent a lot of time on that and educating people on that front to help them be successful. So that was my first exposure to, I guess, the short-term investing landscape. After 2 years there, I was like, okay, I'm done with this game. There's, no one is really building a tremendous wealth doing that. So I learned that very quickly. So I was like, okay, let's move to the institutional side. Let's see what the big players in the industry are doing. And that's where I moved to Thomson Reuters or Refinitiv, which basically what I was doing there is I was providing market data to people who are managing hundreds of millions, billions of dollars in Canada and the United States. But I was on the data side. But believe it or not, when you're providing data to a fund manager, you actually get to see everything that they're asking for. You get to see what they look at. You get to see how they use the data, how they analyze the data. Because through their questions, I could tell what they needed. I could tell what was important to them. I could tell what they were monitoring. So I actually learned so much there from being on the other side instead of being internal, because I was also talking to different organizations. So I could tell some asset managers or even pension fund, but asset managers or smaller retail portfolio managers, even, which I'll cover in a second. I could tell the differences in culture, in values, in approaches, and whatnot. So it was awesome there. It was amazing exposure from hundreds of different organizations across Canada and the United States. But in that time, there was two sides of the business I was exposed to that is relevant to this conversation. So one is institutional portfolio managers, and the other one is retail portfolio managers. Retail portfolio managers would be like the people who I would say we compete, Millen Wealth competes against today. But the institutional portfolio managers are the pension funds, the asset managers like Fidelity, Dimensional Fund Advisors, there's family offices, endowments, and so on. Those are the large institutional portfolio managers. All they do is manage money. And they have a client relationship department that manages relationships with their clients, but their clients are basically advisors or they're family offices and whatnot, right? Like if you think of, like a Fidelity or Dimensional Advisor, like they have all sorts of different, we call, owners or people who have the money are basically putting it with them and then they invest it on their behalf, whether it's an advisor or it's an endowment. So that's the institutional game. So when you think about those guys, they have unlimited budgets to hire the best talent. There's a clear separation between who's managing the money and the end client. And in my role there, I was covering a very particular group of institutional portfolio managers, and they were the quantitative investment managers. So quantitative investment managers are the one who are building factor-based portfolios. They are managing the portfolios based on different factor exposure, which I'm going to share with you kind of the building blocks of the three major factors in a minute. But there are way more than that. Like there are teams out there, and those teams were working at all the pension plans in Canada, pension fund managers in Canada, asset managers. They all have groups that all they do is they're researching different factors. There's 400 different factors. Now, not all of them are necessarily yielding or easy to capture, but there's a lot of different factors. There are 3 to 5 that are the most popular based on academic research, but there's about 400 out, even probably more now out there. So this is what a quantitative investment manager do usually. They research factors and they manage the portfolio's factor exposure to those factors based on the research and what they are able to evaluate or see from the data set that they explore. And usually those people, they're also going to use like data that is very esoteric, like data that, for example, satellite imagery to find how busy parking lots are in terms when you look at, let's say, you're trying to predict like traffic, whether it's foot traffic or car traffic, like within, I would say, malls or large retailers. There's a lot of data sets now that you can monitor oil tankers. At any point in time, you can know exactly how much oil is being transported. So some people are using that to try to predict, like, is there's going to be supply and demand imbalances, whether it's, in the oil market and whatnot, depending on geopolitical events as well. Like, there's so many data set that you can study to try to ultimately predict where's going to be the imbalances in the supply and demand and how that's going to impact prices. So those are the institutional portfolio managers. Now, the retail portfolio managers, those are very interesting. So those are the folks, like I said, like we compete against those as being a financial planner. They might work at big banks, they might be independent, and they carry the title portfolio managers. And usually those people are targeting the high net worth clients. So if you have $1 million plus in assets, you can invest with them, and then they'll tell you that they're the best at picking stocks, they have the best investment strategy. But I want to show you like the comparison because I used to cover those. They also used to buy data from us. And I have so many funny stories from that point in time because I could go to like one of the major banks where there's portfolio managers there that are servicing retail clients, high net worth clients. And I was meeting with them, let's say 4 or 5 in a row, right? And every single one of them was telling me, oh, this is my dividend model and my model is better than the guy next door. And then I was going to the guy next door and he was telling me the same story and then the same story and the same story. And I could also tell in that world who really knew their stuff because I could tell from the questions they were asking me because they were using our platform. But how well they were using the platform was all over the place. Some people were actually really good, very tech savvy. They were researching the heck out of like all the data sets that we were providing them. Now, whether that led to making the best investment decisions, like it's still debatable. But the point is some people were harnessing like a ton of data, but others, they could even open the platform. Like it was, just even monitoring like a list of stocks was hard for them, right? It's what I saw there is like the way they were making investment decisions was not thorough at all. And that was like scary to me. I was like, okay, I can, we can do better than that while managing money for clients. So, but those are the retail portfolio managers. And here's how you compare them compared to the institutional portfolio managers. So the retail portfolio managers, they don't have a high budget to spend. They usually have hundreds of clients, sometimes different sizes. Usually it's above $1 million, but sometimes they have way more than that. They usually don't have a large team to conduct research. They usually don't have the same skills as the people who are working for big institutions to analyze the data, to conduct research and make investment decisions. So when you look at when they're telling you that they can pick the best stocks, their time is very limited between managing client relationships, even if they have support and managing a portfolio on the side, like those are very two important tasks to do. This is not easy. And if you're telling me that those guys can do this as well as the institutions who are, like I told you, unlimited budget, huge army of analysts, really smart people, there's no way. It's not even the same game that they're playing. It's really one-sided, and institutions will, should be doing better. But when you look at the data, which we already shared between passive and active, those institutional portfolio managers, they still have a hard time to beat a simple benchmark. So what is the likelihood that your retail portfolio manager is able to pick the best stocks and beat the benchmark in between 5 clients, 5 meetings a day? I say it's bullshit. I say something is not adding up. One of the reasons why I decided, to the day that I would become a financial planner, I would partner with like-minded financial planners like Sam, and then at Millen Wealth, and we would be offering a portfolio or an investment strategy that is also grounded in research. And I'm going to walk you through in a second why index funds or factor-based funds may be superior. Here are some of the other skepticism that I have with people who claim to be retail portfolio managers who are able to pick the best stocks, for example. If you want to build generational wealth and you're investing with that person, because usually they're going to hang their value around their ability to, so to speak, beat the market. That means that once they retire, then you have to try to find someone else who's going to do that for your kids and your grandkids. And then when that person retires, you have to do the same thing with the next guy and the next guy. So if you really want to build generational wealth, what I've observed is for even my own future kids, my future grandchildren, our clients, our kids' clients, the generations to come, I want an investment philosophy that whether it's me, Sam, our successors, they will have the exact same investment experience through generations. And I'm only confident in that by favoring an index philosophy or a factor-based investment philosophy. The other thing that I've noticed too from my experience at Thomson Reuters and Refinitiv when I was meeting with retail portfolio managers is that a lot of them are picking stocks just as a marketing game. Because if you present a portfolio that has a list of stock where they hang their value, they're saying, I'm the greatest because of those names on that list. It's usually ring-fencing you, the client, to, oh my God, I can't move my portfolio because what if the other guy is not as good as that guy to pick stocks, right? So, but really they're dressing up the portfolio in a way that is trying to like ring fence you, but in reality, like it's just a marketing game. They're using this to differentiate themselves, but there's the value from doing that to you is very little. And we've covered that in the episode 7. But what we've noticed and I've noticed is that you as a client, you get a lot more value from a very thorough and comprehensive financial plan alongside a sound and evidence-based investment plan than having someone who's trying to evaluate whether they should pick Suncor or Enbridge as a stock, because that decision will have little to no impact on your long-term wealth and you getting closer to your goals. So that's another reason why I've decided to choose the route and try to become the best financial planner that I can be, so that I can add the most value to my clients. So that was hopefully that wasn't too long of an introduction as to what got me here today and the approaches that we have around being a financial planning focused firm first and using evidence-based investing, which is index or factor-based funds. Now let's dive into them. Let's dive into what was the rise of index funds? What is factor investing? What are the building blocks of factor investing? In order for me to share that with you, I need to share some key theories that changed the world of finance. And this came from my journey through the Chartered Financial Analyst, the CFA program, which is one of the most recognized designations you can get in the investment management industry. There are 3 theories that I'm going to share with you that you need to understand that are at the foundation or that are the building blocks of index and factor investing. So the first one is called the Modern Portfolio Theory by Harry Markowitz. That was published in 1952. And the Modern Portfolio Theory changed the way we as investors think about risk, return, and diversification. It is a framework for building investment portfolios to maximize a certain returns given a certain level of risk. There are two components to that. Well, three technically. The first one is the expected return of a portfolio. So if you look at any portfolio, you can compute the weighted average return of all the assets in the portfolio. So whether it's stocks, bonds, real estate, your portfolio will depend on the returns of each asset class. So how much weight you have in each asset classes. And then you can have model expected returns from what you're owning in your portfolio. So that's the first key. What is the expected return of your portfolio? Second is the risk. So the risk is usually measured as standard deviation or variance of returns. So a higher standard deviation means that there's more price fluctuations. It means that this investment is riskier. So again, within the portfolio, each asset class and each investments have an expected return and they have a risk. So a standard deviation measured into like how much that asset class will fluctuate. And then there's the correlation. So if assets have low correlations to each other, they will reduce the overall risk of the portfolio. So what the modern portfolio theory found is that with diversification, so by adding assets to a portfolio that has low correlation or negative correlation, you can reduce the risk in your portfolio, but without sacrificing expected returns. This is key. So it's not just about picking any good assets, but it's how do you combine them efficiently? And this is very important and not so easy to do. So one thing I see a lot in my client portfolios, especially who are DIYs, is there's a ton of overlap in their portfolio. There's little to no understanding as to what is the actual risk of the portfolio. And people will usually own different ETFs, which has basically all the same overlap. So they're basically multiplying the risk. They're not diversifying your risk or trying to reduce their risk while keeping the same returns. So a lot of people are actually missing out on that opportunity. And then within the modern portfolio theory, what you can do is you can draw a frontier with one axis, the x-axis being volatility, and the y-axis being return. And then you will have an efficient frontier. And the goal is to be as close as possible to that frontier, because this is where your portfolio will be the most efficient. Because for any given level of risk, you will have or can expect to have the highest expected return. And this was groundbreaking in the world of investing. And that also was the foundation towards buying the entire market. So buying the entire market means you're not trying to pick single stocks. You're just gaining exposure to the entire market. Modern portfolio theory also encourages investors to focus on risk-adjusted returns, so not just returns. And this is key. When someone is presenting you returns, you also need to look at how much risk have they taken to achieve those returns. Because if someone presents you high returns, but they took an excessive amount of risk, then that's not as great as if someone had maybe, let's say, slightly lower expected, but with half the risk. So ideally, you would want the highest expected return possible with the lowest amount of risk if you're a rational investor. And this risk-adjusted returns concept have really changed how investors view returns and how they view risk in a portfolio. But there are limitations to the modern portfolio theory. It assumes that investors are rational. But in reality, investors have biases and they don't always act rationally. Past data isn't always reliable either. So future correlations and returns can change. And it also ignores tails risk. It doesn't really fully account for market crashes and black swan events. Because if you look, for example, at a global equity portfolio, you can have large cap, mid cap, small cap, value, growth, profitable companies with a high investment factor. And in a crisis, correlations can usually move up towards almost one. When everything goes down, then your diversification benefits can appear to be evaporating very quickly during that period of crisis. So that's why it usually sometimes this model can be ignoring tail risk, because unless it's a true negative correlation. For example, if you are invested in U.S. Treasury or, Treasury bonds, for example, whenever there's a crisis and the Fed or the Bank of Canada are lowering interest rates, then the price of the bonds will go up while, for example, equities are crashing. So you will have an offset there. You will have a true diversification. But within an asset class, sometimes in a back test, it can look less positively correlated to growth. But then when there is a crash, correlations sometimes tend to change. So those are the downside of that theory. Now, the second theory is called the capital asset pricing model. That was developed in the 1960s. So there's three gentlemen. So William Sharpe, 1964, John Littner, 1965, and Jan Mawson, 1966. So the capital asset pricing model was built on top of the model of the modern portfolio theory by Harry Markowitz. And the way the capital asset pricing model was developed is to show investors the concept of market risk premium. Like, what is the return that you can expect from taking higher risk than, let's say, a risk-free rate, or then, than the risk-free rate. So there are three components of the capital asset pricing model. The first component is the risk-free rate. This is a government bond, whether it's a treasury bond or Canadian government bond. Investors can expect to earn at least this return, like even in a risk-free environment. Then the second component of the capital asset price model is a market risk premium. So a market risk premium is the extra return that investors require for investing in the stock market over the risk-free rate. So if the stock market was giving you, for example, 3%, but the risk-free rate was giving you 3%, you wouldn't want to invest in the stock market because it has a lot more risk than the risk-free rate. But if the stock market has an expected return of 10% and the risk-free rate has a return of 3%, then there's a market risk premium. There's a 7% spread between the market and the risk-free rate. This is called the market risk premium. The other component of the capital asset pricing model is called beta, which is also known as systematic risk. How much, or what beta measures, is how much an asset moves in relation to the market. Let's just say we're using the S&P 500 as the market. The market has a beta of 1. So if you have a stock that also has a beta of 1, that asset moves exactly like the market. If you have a stock that has a beta greater than 1, then that stock is going to be more volatile than the market. Higher risk, higher potential return. And if the stock has a beta less than 1, that means that stock or that asset would be less volatile than the market. So lower risk, you can expect lower potential returns. And then if the beta is less than 0, so negative, then the asset would move in opposite direction. And that's where you can see sometimes, whether it's gold or, like, in market crisis, whatever, treasury bonds are going up, equities are going down, so to speak. So a lower beta, and this was a key discovery, a lower beta equal lower risk and return expectations. And that model, capital asset pricing model, revolutionized the world of finance by linking risk and expected return together. So now moving on to the third, it's the efficient market hypothesis that was developed by Eugene Fama in 1970. Fama published The Efficient Capital Markets, a review of theory and empirical work. So the efficient market hypothesis argues that financial markets are informationally efficient, meaning that stock prices reflect all available information at any given time. For example, if Amazon releases a news that they will start using drones to deliver their packages, as soon as that news is released, the market is going to digest it. The price should adjust instantly for any new news that is being released constantly, if markets are truly efficient. And that there are three levels of efficiency: weak, semi-strong, and strong. As a general concept, and then the data is backing that up as well, If you understand that the news is digested directly or instantly by market participants and that the prices are adjusted instantly, then it makes the news irrelevant. And once you understand that, that totally changed the way I even consume news, what I look at, how I, of course, make investment decisions, how I recommend clients to invest. Once you understand that, it really brings you a ton of peace of mind and comfort. And, I feel a lot more grounded knowing that this is just noise and our job is to ignore this because prices are already reflecting that as soon as it's published. So this theory, the efficient market hypothesis theory, basically also state that it's impossible to beat the market. So if you look, whether it's a technical analysis or you look at charts, well, the prices are already reflecting past prices. If you look at fundamental analysis, if you're studying, let's say, the past 10 years of financial information, the financial statements, cash flow, balance sheet, income statement, and then you're trying to see trends and stuff, this information should already be reflected in the current prices, if you agree with that theory. So that means also that investors cannot consistently earn excess returns, so above the market averages. Investors cannot consistently earn excess returns without taking additional risk. And this is key again. It's another breakthrough discovery around risk. If you want higher return, you must take higher risk. It's another way of linking risk to return, which was already done through the capital asset pricing model, which was already also done in some ways through the modern portfolio theory, where for any portfolios, you can have the expected return and you can have a given level of risk that we can study that. So that's leading us to the implications of efficient market hypothesis for investors. The active versus passive debate, which we've covered in episode 7. If EMH is true, then active management, stock picking, market timing is a losing game in the long run. Investors should passively invest in a broad market index funds like the S&P 500 to match market returns at lower cost. And then Warren Buffett made a famous bet against hedge funds where basically he said that I can't remember the gentleman's name, but basically that gentleman could pick any hedge funds that he wanted, but that the S&P 500 index would beat him and any of his picks over the next 10 years, and then they would give the money to charity. And I can't remember the exact outcome. I'll probably have to dig it up. But Warren Buffett, actually, he was losing at first, but then after that, he won. I can't remember what the margin was. But yeah, that's another story. Funny enough that Warren Buffett is also known as one of the greatest stock picker in history. But then when it was time to bet against hedge funds, he actually picked an S&P 500 index. I think there's a lot to learn here from that. Another thing about the EMH is now that it supports the concept that essentially prices are random. So whether you're looking at charts or whether you're trying to predict like where prices are going to go in the short term, it's all noise essentially. Because again, any new information is being digested right away, and it's only unknowable information that will move prices. We don't know what the new information will. We can't predict that. That means that trying to time the market is almost impossible. And then the third is there are market anomalies. So even though that efficient market hypothesis suggests that markets are perfectly efficient, in the real world, there are anomalies that exist. And the anomalies, I'm going to get to that in a second, but there is a few. There's like, for example, value stocks outperform growth stocks. That was the model they later developed. There's a momentum effect. Stocks that have done well tend to keep doing well for some time. And then there's behavioral biases. Investors are fearful, they're greedy, there's herd mentalities, and you can see that in all sorts of asset classes, whether it's Bitcoin, cryptocurrencies, and so on. But again, the efficient market hypothesis is also has a lot of criticism. So, why, if markets are truly efficient, like why is there's market crashes and bubbles? Again, like I mentioned, there's herd mentality. Investors are not always rational. So when investors are irrational, that's also contributing to excessive optimism, excessive pessimism in the market. The other thing the other criticism is around like, why is there successful investors essentially? So if no one can beat the market, how do investors like Warren Buffett and Peter Lynch generate above average returns? And there are hedge funds that have, returned 30-40% a year for an extended period of time, which is crazy. Again, there are anomalies there, but those are very few and far in between. But the bottom line is, are markets truly efficient? In the long run, markets are very efficient, making passive investing, index funds, the best choice for most investors. But in the short term, there might be inefficiencies that exist, even though that skilled investor may take advantage of, there may be some inefficiencies that exist, but capturing them is extremely hard especially for retail investors who have almost no budget, to invest in terms of buying data, analyze data, making sound investment decisions, hiring top talent to digest those prices to make investment decisions. For retail investors, it's really David against Goliath type of relationship here. Do you remember when I mentioned the anomalies? So this is leading us to the most popular factor investing or factor-based model, which is based on 3 factors. Or originally was based on 3 factors. And it was published by Eugene Fama and Kenneth French in the early 90s. And it's called the Fama-French 3-factor model. So the 3-factor model, it improves the accuracy in describing why certain stocks return higher than, let's say, the market. Why is there's outperformance of certain stocks? Is it because managers really pick those stocks, or is there more to it? And that's what Fama and French discovered. They extended the CAPM, because if you look at the CAPM, it was only looking at beta, the stock's beta in relation, or the asset beta in relation to the overall market. But there's more factors. So beta was like the market factor is the first factor, but there's 2 other factors that Fama and French discovered. So the first factor was, like I mentioned, the market risk. How much, what is the asset in relation to the market? So that's the first factor to explain the outperformance of a stock. So for example, if a stock has a beta of 1.2, then it's 20% more volatile than the market, and it should provide higher expected return to compensate for the risk that the investor is taking by investing into that stock. Okay, so higher risk, higher expected return. That's the market factor versus the market. The second factor, it's called the size factor. So small stocks are expected to outperform large stocks. So historically, small stocks have outperformed large stocks over long periods of times. And this is called the size premium or size factor. The reason for that can be due to the fact that they're less liquid. They have higher business risk. There's less analyst coverage. So from the sell side, when I covered that in the previous episodes, like who's covering that, who's recommending those stocks to institutional investors, those smaller stocks have little to no coverage, and they have higher growth potential. It's a lot easier for a small company to double, triple, 10x their revenues than it is for like an Apple, for example, to 10x their revenues given the size that they're at, right? So with that, you can expect, if you invest in smaller stocks, to expect higher return than if you were expected in large stocks. And then the third factor is called the value factor. This is where value stocks are expected to outperform growth stocks. So value stocks are identified usually as a high book to market ratio, and then growth stocks is low book to market ratio. I prefer, it's easier for me to understand actually the price to book. So if you just reverse it around, so a value stocks will have a very low price to book ratio. If you look at the value of their assets, the price you're paying for them is going to be usually a lot lower than the price that you'd pay for growth stocks. So for the same level of asset, a growth stocks is going to be, 2, 3 times, 4 times more expensive. The reason why value stocks are cheaper is usually because they may be underpriced or they're unloved. They may be out of favor. The companies can still have strong fundamentals, but they somehow have low stock prices. They also can be expected to be slightly more resilient in economic downturns because they're already at a price that is more in line with their fundamentals. So a few examples of, let's say, if we look at the top holdings in a value fund, you can expect to see stocks like JP Morgan, Exxon, Berkshire Hathaway. And if you look at the top holdings of a growth fund, you would see NVIDIA, Meta, Apple, Microsoft, and so on. So those are the 3-factor model that were developed by Fama and French. Market premium, size factor, value factor. And the Fama-French 3-factor model was also enhanced in 2015 to the Fama and French 5-factor model. And the 5-factor model, the 2 new factors include the profitability factor So firms with high profitability tend to have higher expected return. And the investment factor. Firms that invest conservatively tend to outperform the firms that invest aggressively. And when you look at the 5-factor model, it explains 90 to 95% of the stock's returns variation in a diversified portfolio. So if you look at the expected return of a portfolio versus the market, when you look at the outperformance of that portfolio, and you study the 5-factor that I've covered you today, you can explain 90 to 95% of those excess returns. This is the biggest takeaway because there's little to nothing left, and that's also what this data shows, to differentiate between skill and luck for that manager for picking those stocks. And the reason for this is because if a manager outperforms, you can look at what was their exposure. Oh, okay, they were exposed to value stocks and small cap stocks. Oh, great. So that explains why that outperformance. Or they had stocks with a high profitability factor or a high investment factor. But there are limitations to the 3-factor model and the 5-factor model. For example, size and value are not always reliable. There will be periods over time, and we've seen that. I mean, we have these conversations time and time again with clients. There are times when large cap will outperform small cap and that growth stocks will outperform value stocks. It's not a guaranteed way of outperformance. But if you look at over the past century, even though there are periods where certain factors don't always pan out, if we look at the past 100 years and we look at the academic research and the data and the periods where those factors have outperformed, we can have the highest probability that over the next 100 years, can expect a similar outcome. That is the takeaway from this. But if you look at, let's say, the 1970s, cash returned higher than stocks. Does that mean that you should never invest in stocks and you should put all your money in cash? Clearly not. Like the stock market has done phenomenally well above the market risk-free rate over the, especially when rates were all down to zero in the 2010s. Or even when they brought them down, during the pandemic and whatnot, even after rising, yields will be around like 4 or 5% at GIC and markets will return, 20, 25%. So clearly there are periods where, yes, factors may underperform, but over the long term, we can expect them to deliver on their outperformance. Lastly, I want to touch on the adoption. So that was very interesting. And I took this data from our friends at PWL Capital based on their research around passive versus active and fund flows, which I thought was very insightful. If you look at the United States, in 2010, passively managed index funds accounted for 19% of the total assets by investment companies. In 2023, it accounts for 48%. So it went from 19% to 48%. And in 2023, passive funds held more assets than active funds, making a pivotal change in the investor preferences. So people are catching up with this and they understand why someone should move away from active management to the first step would be index funds. And then we're here to educate you that you can go one step beyond index funds and then move to factor-based funds. You can move beyond the market premium and then you would include the value factor, the size factor, investment factor, profitability factor. But if you look at Canada, active funds, as of 2022, active managed funds constitute approximately 84.5% of the total assets. That's how much we're behind. Passive funds, so passive funds account for about 15.5% of AUM. 85% of the money in Canada is invested in actively managed funds. And I don't know what the average MER is, but I would probably bet it's probably between 2 and 2.5. That is how much behind we are compared to the United States. It's ridiculous. I don't know if we're that stupid or people don't know, but this is incredible to see that much of a difference. That's how much of an opportunity there is for investors to catch up with the theories that have been around for 70 years that changed the world of finance. The data is there and the academic research is there and the underperformance by active management is there. So I think it's just a matter of time before people realize that they've been overpaying for returns that have underdelivered. So that is the exposure. And then who should use index funds or factor-based funds? I want to leave you with this. So the market doesn't care whether you're 20 years old or 80 years old, whether you're accumulating money or decumulating money. The investment opportunities is the same for everyone. Now, some people, if you work for one of the Mag 7 or you're an equity competent employee and you should reduce your exposure to like the tech sector, there are some slight modifications that can occur. But as far as market opportunities and efficient markets, the investment decisions and the investment philosophy should be grounded on the investment opportunities based on current market prices and exposing your portfolio to different factors that are available to all investors, regardless of your skin color, your religion, your age. The market doesn't care at all about that. But the differences in your portfolio is going to occur based on your risk exposure as far as the asset class that you invested in. Someone who's 80 years old in retirement relying on income is going to have a very different portfolio than someone who's 20 years old and accumulating for retirement. But that differences will occur in weights around their asset class, not how the portfolio is constructed and how much of each stocks they should own, because that investment philosophy is transcending every generations, every age, every investor. You either agree with the data and understand the data and believe in the market factor that I shared with you, value factor, size factor, investment factor, profitability factor, or you don't, regardless of your age. So that's the biggest takeaway here. Do you agree with what I shared with you today? Where are you at in your investing journey? I hope that you found this insightful and that is helping you or your friends or people around you to make better investment decisions and to see what else you could be doing that could be helping you get closer to your long-term goals. As I mentioned, if you think we can help you, you can always reach out to us. You can visit our website at mwadvisors.ca. You can also subscribe to our newsletter. You can book an intro meeting. We do 60-minute financial review as well. You can follow us on social media to stay in touch, where we post almost daily. And thank you very much for listening, and see you in the next episode.